In market news now, global stocks rallied with sentiment supported by China's efforts to shore up its battered markets and lift confidence. London's FTSE rallied over 1% after playing catch-up. This follows yesterday's UK public holiday, while US stock futures suggest a firm open for Wall Street later on. Hong Kong saw its stocks rally almost 2%. Meanwhile, market attention turns to key monthly US jobs data, which will be released at the end of the week. Speaking at last week's Federal Reserve annual symposium at Jackson Hole, Fed Chair Jerome Powell said that the U.S. Central Bank may need to raise interest rates further to ensure that inflation is contained. To give us the latest when it comes to the markets, we are joined by Martin Smith, who's a portfolio manager at Anchor Capital. Martin, thank you so much for your time. So given what is playing out in the markets right now, what is your sense of what's driving that?
I think it's a couple of things. So offshore, you've got, I guess, a market that's still a little bit nervous, but it's still a little bit optimistic that things are going to kind of be better than initially anticipated. So you've seen that with the offshore market starting to still slowly tick up and grind higher. Locally, we're trying to find a little bit of momentum. You saw a massive risk off kind of movement over this month. You've seen the market sort of pretty aggressively over the last couple of weeks. And you see our local market just trying to get some momentum, trying to get some risk on. Obviously, you've had that news out of China, which is helping. So I think the market is, for different reasons, both locally and offshore, cautious, but with the optimistic slant, if that makes sense.
So in terms of any company news or events that caught your attention, there's quite a bit happening this morning, from whether it was Master Drilling, Super Group, or even just moments ago, Sibanye-Stillwater reporting earnings. What caught your attention?
Absolutely. So, I mean, there's lots of news going out there from companies as well as kind of bigger, broader things. I think we are so kind of macro driven at the moment. I think that seems to be kind of our main focus. And I think if you look at it from that aspect, I think oil ticking up in the background to around $85 now is quite an interesting one, and one that we need to keep an eye out for, I think, because of those first order and second order inflationary effects that could have. So that's one that I'm keeping quite a close eye on. And then the other is, I think the big kind of story of the last week is Jackson Hole and what Powell said and how that's affecting markets and market sentiment. I think everyone is kind of waiting with bated breath, and I think that's the big kind of rhetoric at the moment. And like I said, it's interesting because we normally focus on companies like kind of a lot more, but I think also it's now very much a macro story as well, more so than in previous years.
Let's stay with that, because you have US payrolls figures out on Friday, and then on September 13th, we have US CPI. With all of that, and with the Fed being data dependent, what does it mean then for your expectations come the Fed meeting? Are you expecting them to pause or to hike?
I think we're expecting them to pause. If you look at what consensus is saying, there's about a 20% chance of them actually hiking now at the next meeting. But I think afterwards, I think you should probably see about a 25 basis points hike. Markets pricing about a 66% chance of that happening later on in the year. So it looks like it's coming. It fits the narrative from Jackson Hole this last weekend, of higher for longer. And again, the market initially a little bit of a kind of sell-off, but we've seen it starting to rebound nicely from here. So market doesn't like uncertainty, and now we've got a little bit more clarity as to where interest rates are going. But for now, I think they'll pause, and the following meeting, I think we'll see a hike.
All right, so let's bring things locally. We have Thungela Resources, which is the coal miner that was spun out of Anglo American, and they released an announcement this morning, said that they've officially taken control of a coal mine. I'm interested to know your assessment of Thungela Resources since its debut. What do you make of its performance?
It's been an incredible story, right? Like you mentioned, spun out of Anglo's for around, I think, 29 Rand in 2021, so not so long ago. And I think it peaked last year around 380. So you saw massive share upside in the stock, which was incredible for holders. You also saw nice dividends come through as well, because if you look at where they were from a resource perspective, what coal prices had done was absolutely incredible, and they benefited from that. It was literally incredibly cash generative for them, given what spot coal prices had done. So they were very much in a sweet spot, very much a kind of once in a 10-year situation for them, and that was great for them and their shareholders. You've seen the share sell off down to about 150-ish, 160-ish now on the back of firm coal prices normalizing. And I think we'll probably see that trend continue. But again, it's been a very good news story for shareholders who held post the spin-off and decided to buy more.
Okay, so sticking with that theme, when you look at the markets right now, whether it's the US or locally, are there parts of the market that seem attractive or that are holding up when it comes to resiliency, given the background?
I think, like I mentioned at the beginning of the show, there's quite a lot of cautiousness and nervousness in the market still. And I think you don't need to necessarily be in equities to get a decent return, both locally and offshore, given the yields that you can achieve. Offshore, you can get 5-6% in dollars quite easily. And locally, I mean, bonds are giving you kind of 10, 11, even 12% in certain places. So you can get quite nice yielding assets at the moment without kind of taking as much equity risk. But if there is a place which I think could be interesting at a point in time, given how cheap it's looking fundamentally, is the emerging market space, China, which can lead into South Africa. So that's one to keep an eye for. But again, there is a bit of a risk-reward spectrum there.
Okay, so with China, what are you liking there, given the concerns about its growth outlook and some of the stimulus measures not being enough?
I think it comes down to the stimulus side of things. You've seen pretty disappointing economic data out of China over the last kind of 6 months, or basically for the year. And I think the market's been a bit disappointed by the level of stimulus that's kind of come out from the Chinese government. I think they've been a lot more patient than they have been in recent history. And I think the market's waiting for some real stimulus to come on board and to really kickstart that economy, because like I mentioned, the data points haven't been great. If that comes through, you'll see a very nice flow into Chinese stocks and the Chinese economy, which has a direct influence in South Africa, from our resources to even things like Tencent's impact on Naspers and Prosus. So if China goes well, then South Africa market also does well.
All right, Martin, thank you so much for your time. That is Portfolio Manager Martin Smith from Anchor Capital, giving us his perspective on the markets.